Welcome, ladies and gentlemen, fellow traders, speculators, and investors, to this little excerpt from one of my introduction and workshop on how to trade spreads. It usually consumes 2.5 to 3 hours when I give the fully blown workshop with best practice and everything you need to know about spreads if you want to start trading them. But we will go into an intuitive approach. We will have a look at time, volatility, wing size, distance to payout, and we will not go in all to the other grayed out key points I have in here, how to set it up properly. So what are spreads? If you are an investor who's only used to trade with the cash instrument or with futures, you have a couple of opportunities. You want to buy something? Well, then you buy something. You buy a cash underlying, you buy a future, or you want to sell something, then you short it or sell it. The future, the cash underlying, whatever the asset is you are interested in, and that's pretty much it. In the meantime, you are busy with managing the risks you have in this portfolio. Options give you an opportunity to actually say, okay, fine, how can I approach this whole topic of investing a little bit different? Brief introduction. Who's talking to you? Thorsten Roland Wegener. I used to be a market maker for now, almost 30 years. Moved on in the industry, went up the ladder. I don't know why they did that, but they obviously liked me. And I retired as a partner at Bear Stearns in London for the derivatives business. And now I am a lecturer, house husband, and apparently a YouTuber. So I hope you enjoy this little presentation. Let's start. We are the investor in the middle, the guy with the tie, and beneath it is the scale which says the market is today trading at 100, and it can fall down to 75 and it can go up to 125. So what opportunities do I have if I have the idea that markets will go up and down as a cash investor? I already said, well, you simply buy the underlying, and then you have to manage your risk if the market goes against you, or you have to increase your size if the market goes for you. You know the spiel, what to do in these cases. But options give you an opportunity to actually place an intelligent investment or a speculation that something will happen in the future, or even the other way around, something will not happen in the future. It's like Sherlock Holmes, Arthur Conan Doyle's The Dog That Did Not Bark in the Night. You do not have this opportunity with just cash. If you think something will not happen, well, you don't do anything. However, with options, we have the opportunity to get further involved into the markets. What are we having here? Let's get right into it. We are at 100, and you have the assumption that the asset you prefer will at a certain time period go up to 125, or it will go down to $75. A spread is two options you are trading in its simplest form to say, okay, if this happens over the next 3 months, 6 months, 2 years, I want to have a fixed payout if we are at 125 or if we are at 75. So you have to buy this right for a fixed payout. I call it a projected fixed payout because it all depends on, have you got the right idea? Is your analysis sound? Will the market actually develop in the direction you were planning? Then you will get the fixed payout. And you can decide while setting up the option structure whether that fixed payout is $10, $100, $10,000. Obviously, you'll pay a price for that. We come to that next. This is the red little symbol for the dollars. By buying the right to participate with a fixed projected payout at a certain point in time, when the contract or the investment or the bet you placed will expire, you get this amount or you get nothing. It's a very digital payout. You say, okay, market moves up to 130. I'm not interested to get then more money if the market moves to 130, 140 or 700. You will just be dependent on that the market has hit your target. The 125 in this case. At 125 you get, for example, a payout of $1,000. Or if the market falls to a level of 75 over that time period, you will get a payout of whatever you choose when you set up the trade. Obviously, you have to pay money for that. That is called a debit spread. Yeah, debit goes out of your account. You buy the right if the condition arises in the future to receive money for it. So if you can buy this structure, obviously there has to be a seller on the other side. The seller, that's where the dog didn't bark in the night, says, no. Whatever you think is possible, it's not going to happen. Because therefore, I offer you the right to place this investment and say, okay, if the market goes to 125, you will get the payout. So I'm offering to be the person who's providing you with this pot of gold, with the cash, if the condition arises, for that risk I'm carrying. Obviously, I have to be paid. You can see that when we go one slide back, the buyer, the person who wants to make this investment, has to pay for it. And the person who provides the ability for the first investor to make this speculation obviously has to pay a premium for it. That's the debit spread. You have to get money out to get money in at a later point if your idea works out. Otherwise, you've simply lost the amount you paid for. There is no bigger amount. There is nobody calling you. You don't get a margin call. When you set it up as the buyer of this structure, that's as much as it can cost you. The money you paid for this premium. So, how's the payout at how's the probability of profit when we look at these structures we can choose? That's the starting position we had, and I simply left the price and probability right in the middle. So there's no scaling to it. It's just to give you an idea what it actually means. So if you want to place your speculation, let's look at the upside again, at 115 instead of the earlier price of 125, obviously it's more probable that your idea might go in and make you some money. We still have a bell curve, where this stuff is priced on, where a lot of things happen right in the middle and the outliers are less likely. However, when I move closer into the middle, then obviously it's getting more probable, and if something gets more probable, then the price for this will rise. And if something gets less probable, well, the price will go down, because we are always paying for the probability to make money or to lose money in this setup. So that's already the first thing you have to understand. You can determine if you trade spreads in the market at a proper stock exchange, not at some dodgy outlet which lets you place a bet. I can decide how this digital payout, what it will pay out, and I will have an idea what I have to pay for it. The market maker will provide me prices for these trades I'm planning to do, and I just have to hit him or her, and then I'm in for a ride. So there's also time involved in this whole procedure. Let's say we've had an idea now. We say within 3 months time, I believe that the S&P will trade at 7,000 or above 7,000. All right, what's happening then? Once I've done this trade, I found a nice market maker who is selling this right to me to get a fixed payout if we're above 7,000, and I agreed to pay a price for that. We're all happy, right? So now time is moving on. Let's look from the perspective of the buyer. You bought this investment, this bet, this speculation. If nothing happens, the probability is decreasing. If the probability is decreasing that you will hit your target either here or here, if you bet on a crash, then the price will go down. You've bought something, let's say at 100, and now it's suddenly worth only 50 because the market did not do what you wanted it to do. However, again, how much can you lose? Only the amount as the buyer of this spread you have originally invested. So let's look at the volatility of the market. Big topic, obviously. We start right in the middle. You set up this trade. Price, again, you bought it at 100, and the probability is 50-50. We're right in the middle. That that the market will move up or down the next moment. And we're going now and say, what happens if probability is increasing? Suddenly, the 125 at our starting point gets more likely, as well as the 75. The down move gets more likely, because in the calculations for the pricing for these spreads you can trade, the market is pricing volatility, upside and downside volatility. So if volatility is rising, both events get more likely. And if they get more likely, then the probability will influence the price and they get more expensive. If suddenly markets start snoozing, nothing's happening, everything is hunky-dory, nobody is expecting any large moves, then the probability to achieve your goals here or here is going down. If the probability is going down, the price of this contract you bought is going down. For whom is that a good development? For the guy who sold you the contract, because he sold you something for 100 and now it's worth only 20 or 30. So he made a profit, and you in your books, at the moment at least, have the loss equivalent to his or her profit we have in here. Then we have to look at the spreads. The wing size. What is a wing? A wing is determining how much payout you're going to get at the end of your trade. So if you want to have a payout here, if the market goes about your 125 threshold, if you want to have a payout of 100, you buy something at one level and sell another option slightly above this. All right, for the option you're buying, because it's closer to where you are right here, it's more expensive. And if you sell an option a little bit above that to hedge you only are interested in a fixed payout at the end of your transaction. Then it's taking the profit you start making at the lower price away when you arrive at the higher price. And from that on, there's no difference anymore. You just get the payout that is in this spread you have involved. So what can I do? I can obviously say, I want to have a higher payout, so I simply move the other side away. In our example, let's say you bought a call at 125 and you sold the call at 126. If the market is at 127, you get $1. If the market is at 700, you also get $1 out of it. Okay, but you want to have $10. So you're not selling the 126 call, you're selling the 135 call, which means if the market is then going to 136, you'll get $10 in it. So we've increased the spread size, the potential profit for this, right? There's always a seller to it. The risk for the seller is obviously higher in this scenario. If the risk is higher, he wants to or she wants to have a higher price if you increase the wing size. Interestingly enough, the probability that you will go over your initial threshold can be seen at different points. The probability is calculated on the long option you have in this scenario. You want to be long at 125. If you move the spreads, it's not changing how likely it is that you will go above 125. Obviously, if we extended our wing size, then we have more money we can make, or the seller of this structure has more money he or she can lose in there. So obviously he wants to have a higher price for that. You have to pay a little bit more, and the other side will receive a little bit more. Probability is not changing a lot. You are just considering that we call them the tails, to the upside and to the downside, will involve a greater risk for the seller or a greater opportunity for the buyer in this scenario. And the same is true if you keep it really tight and narrow, as my initial example was, when I am long a 125 call or a 75 put, and I sell the 74 put against it, or I sell the 126 call against the market on the upside, then I have a spread which gives me exactly $1 as a payout. If I do that 1,000 times, obviously I make $1,000 on this. The interesting side effect of it all is the price you pay today is pretty much the probability that you will be successful priced on this elusive bell curve. Let's say we have this very tight structure like here. You are going long a 125 call and you're selling a 126 call against it. You can only make $1. If the market is at 500, you will have made $1, or if the market is at 120, you will make nothing. Well, that's the downside. For this, right now, today, you have to pay something. Let's assume for the opportunity to make $1, you have to pay 10 cents. Yeah? This 10 cents is your probability that the market says, there's only a 10% probability that you will make this money at this level, because that's what the market is pricing in. So that's all the magic we have in spreads. Obviously, there are ways to construct it the proper way. The stuff I've grayed out on my presentation, but I hope this has already helped you a tiny bit to understand why spreads give us an advantage to just being able to trade cash markets long or short. See, there's a German word slipped in, but maybe that's why you're here, for the German accent in my English. Anyway, we're not going into spread construction, but obviously I have my recommendations of interesting literature to these topics, and if you want to know more about spreads, I can't say it often enough. Buy this book, Sheldon Nadenberg, Option Volatility and Pricing. That was the first book that was on my trading desk. There is a second edition as well, and it gives you a fantastic oversight how you build a spread, what is important, how to get into the Greeks, how everything. If you are out there and you don't want to spend too much money on your education, you come back to this channel on YouTube and watch our videos, and you buy one of the reference books for market makers, for traders, to give you a real professional idea what's happening. I thank you for your attention. If you liked this brief presentation, this excerpt of a larger one, I would be happy if you leave a comment in the YouTube thingy, if you like it, if you share, and of course I have to slip in the evil risk disclaimer. Everything I showed you today is no investment recommendation. It's not telling you what you should do, how you should invest your money. It's an overview, it's a lecture, and I hope you take it in that good spirit. Hope to see you soon on this channel with another interesting topic that crossed my desk. See you soon. Bye bye.